My name is Darren. Our team seeks to demystify the sometimes confusing world of international tax. This, again, an overview of the tax system in the US. The US has quite a complex tax system. The first point I have on the screen is that comparisons are drawn with Brazil. For international tax nerds, it's like a point of contention, a debate, which one has the more complex tax system. Suffice it to say that both are very, very difficult, and it's impossible to find one person who knows all of Brazil's tax, and similarly, no person could know all of the U.S. tax. And the U.S., the income tax could be up to 4 levels. So let's say you lived in Queens, in New York, you would have to file a tax return at the federal level, so to the IRS at the US. You'd also have to file a tax return to the state of New York. You'd file a tax return to the city of New York, and you may have to pay local taxes to Queens as well. So it can get quite complex. And what is also an interesting point is that, for example, in Europe or Portugal in particular, when you see an income level, you can more or less assess or guesstimate what the effective tax rate will be. But in the US, because there's so many deductions, you are not going to find anybody who pays whatever the headline tax rate is. Everyone is entitled, if they so choose, to an array of deductions, both in their personal tax returns and especially for their businesses, which will bring down the effective tax rate. So that's something to bear in mind. So we have the direct taxes. And of course, just like in Europe, you have the indirect taxes. So in Europe, you have VAT. In the US, you have sales and use taxes. The sales and use taxes are quite complex. And it's, as I said, it's a discipline of its own, just like it is in jurisdictions like the EU. In that, yes, you have 50 states in the US, but those 50 states are in turn divided into over 10,000 sales and use tax jurisdictions. So again, anybody who claims to know everything, you're not going to know 10,000 rules, right? There are different rates, there are different reporting options, the different reporting cycles as well. Previous to 2018, you triggered sales and use tax by normally having a physical presence, like you have a warehouse or you may have an office, you have staff, you have a shop or something in that jurisdiction. Post 2018, there was an important case in June 2018 called the Wayfair case. And as a result, we have the concept of economic nexus. So just by virtue of having business activity, so selling into jurisdiction above a certain threshold, you trigger that indirect tax, which we call the sales and use tax. So again, it's for those of you who are running businesses that have physical products, it's something to bear in mind as you plan. And for those of you who are into real estate, of course, you have property taxes like you do in most places. It varies even within a state. It could vary and quite significantly, but generally speaking, just painting with a really broad brush, Hawaii is the lowest and New Jersey is the highest. Average, these are averages. So obviously within an average there, it goes higher and lower, right? So generally speaking, if it is that you're looking at real estate and you're building your models, you're looking at a property tax of between 0.2 and 2.5%. So that's, again, a very broad overview of what is a complex situation. Obviously, if you're looking to expand a business or you're looking at investments, you'd want to work with a tax team who understands it to help make sure that you get the planning right and to get the modeling right.